Hello and welcome to today's webinar on ISAs. So this is part of our Back to Basics series. So really in the session, hopefully just cover some of the fundamental technical points on ISAs and then have a little bit of a look as well at any potential changes that we might think are coming along down the lines. So in terms of the agenda, as I said, just look at the kind of the high level technical summary of ISAs, so the different elements of it, so who's eligible to take out an ISA, how the subscriptions work, and then we'll look at withdrawals, transfers, and a little bit on ISAs when someone passes away as well. And then, as I said, looking at some of the potential changes that might be coming up to ISAs, because there've been quite a lot in the press recently around that. So a very high level, what is an ISA? So it's a tax wrapper, so it's a tax efficient saving or investments account. ISAs are completely free of any income tax and any capital gains tax as well. So any investments within the ISA environment, you're not having to pay any income tax on any kind of dividends or savings interest, and gains as well that are made within an ISA, as I said, completely free of capital gains tax. So a really tax effective way to save and invest. ISAs don't get any tax relief when they're actually funded, so subscriptions usually come from taxed income. So in terms of tax policy, ISAs are referred to as TEE, so from a taxable environment into an exempt environment, and then the withdrawals are also tax-free as well. So any income taken from an ISA environment, again, isn't liable for income tax. So that TEE is the sort of the tax policy side of it. A pension is the other way around, because you get tax relief on contributions into a pension. Those funds then grow in that tax exempt environment, but any withdrawals from a pension are taxed as well. So it's kind of the opposite way around to the ISAs. Another couple of quick points. So the management of an ISA is done by an ISA manager. So this is a firm that's approved by HMRC. They then liaise with HMRC in terms of reporting subscriptions, notifying any invalid subscriptions, those kind of things. That's all handled by the ISA manager. And another important note is an ISA, because it's an individual savings account, the beneficial ownership lies with the investor. So that means a couple of things. So you can't have a joint ISA, for example. It's just an individual account, and things like ISAs can't be assigned to a trust or into a bond or anything like that. It's just a very simple tax wrapper in terms of things like that. So just a bit of the history of ISAs. We've had them since 1999 now, so over 25 years of ISAs. Initially introduced as kind of two types, being cash and the investment stocks and shares one. And over the years, we've had sort of different developments within that as well. So currently there's 4 types of ISAs available. So cash ISAs, essentially just a savings account with a bank or building society, but any of that interest that's generated there will be free of tax. The stocks and shares ISA, which again is just an investment account, so similar to a general investment account, but it's within the ISA environment. So they're kind of the 2 main ones. We also have the innovative finance ISA as well, so that was introduced in 2016. We haven't seen a great deal of take up with those. There's not that many providers actually offering them, but their primary investment is kind of peer-to-peer lending, those kind of things, but it is an available ISA. And then more recently, we've had the lifetime ISA introduced. So this came out in 2017. So the lifetime ISA, will come on to how it works in practice, but essentially it's got kind of a prescribed usage for it, so that being helping someone buy their first home, but also looking a little bit like a retirement product as well. So they're the 4 types of ISAs that are available to adults. On top of that, we have junior accounts as well, so you can get a junior cash ISA or a junior stocks and shares ISA. So those accounts work the same, but they're focused on children. And we also did have the Help to Buy ISA as well. So the Help to Buy ISA was a variation of the cash ISA, essentially, where it had some government bonus added in when you were purchasing your first home. That's now been replaced by the lifetime ISA, which works in a similar fashion, but there may be individuals who still do have Help to Buy ISAs. It's just you can't have a new one any longer. So if you just look at kind of the popularity of ISAs, or try and measure the popularity. So this is just a snapshot from the published statistics from HMRC, so the latest figures back in September last year. As you'll see, this amount, this bar graph here is the amount subscribed to ISAs each tax year, and it's been consistently fairly high numbers, all the way going back all the way to 1999. So in the last tax year that we've got figures for, 71.6 billion was paid into adult ISAs, so pretty big sums of money. It's been fairly consistent over the years. In 2015 to 2016, there was quite a big spike over those two periods. I think that correlates to when the ISA allowance went up to 15,000, when it was 10 previous to that. So yeah, big amounts of money going into ISAs each tax year. So they are a very popular product in terms of general kind of retail clients, and obviously in the advised marketplace as well. You'll notice on the graph as well that the colours represent the types of ISAs, and consistently the cash ISA is the most popular, or where the majority or most of the funds are actually being paid. This has recently been identified as potentially a slight issue because lots of people are putting money into just cash accounts when cash doesn't have particularly good returns over a long term. So this is something that the FCA have looked at, and we know the government are looking at as well. So when we're looking at those potential changes, this is something that's been highlighted as well. So we move on to eligibility. So who can actually open up an ISA account? And it's a pretty broad eligibility criteria. So for the main types of adult ISAs, so cash, stocks and shares, and the innovative finance ISA, the rules are you need to be at least 18 years old and a resident in the UK. So that's the primary criteria. So an adult over 18 and being resident in the UK. Citizenship doesn't come into ISAs, it's just based on that residency. So anyone who does have UK residential status will be eligible to open up an ISA and fund it while they are UK resident. There are some rules around Crown employees as well. So if you're a Crown employee living overseas, you can still open up an ISA as if you're a UK resident. The main example we see of Crown employees is people in the armed forces. So if you happen to be staying in an Air Force base overseas, you can still open up an ISA as if you were based in the UK, and that applies to your spouse as well as that. That final bullet point there, you can now subscribe to multiple ISAs of the same type in the same tax year. Previous, that wasn't allowed. You could only have one type of ISA each tax year. If you subscribe to 2 stocks and shares ISAs, for example, the second one that you set up would be invalid and would have to be closed down. Not long ago, they did relax that rule now, so it is a bit more flexible in terms of having multiple ISAs spread across different providers if someone did want to do that. So there's a bit more flexibility. The lifetime ISA is slightly more restrictive, and the main difference is there's an upper age limit in terms of who's eligible for a lifetime ISA. So you must open and fund a lifetime ISA before your 40th birthday. So that is quite a different restriction in terms of the main types of ISAs. Again, the residency requirements are the same. So if you're based in the UK, you can have a lifetime ISA if you're within the age limits. Crown employee exemption applies as well. And with the lifetime ISA, you can't have 2 in the same tax year, so you must not have opened another lifetime ISA in that tax year, so that restriction's still there with the lifetime ISA environment. Junior ISAs, again, fairly simple. So the child themselves needs to be under 18. A junior ISA is set up and managed by what they call the registered contact. So that's the person who sets up the accounts. They must be at least 16 years old, and they must have legal parental responsibility as well. So that means it needs to be mum, dad, or adopted parents. So quite often we'll get asked, can grandparents open up a junior ISA for their grandkids? And they're not allowed unless they do have that parental responsibility. So it is just the parents who can actually open up and manage the lifetime ISA. The child themselves must be a UK resident. That Crown employee rule applies to children as well. So if they're a dependent of an overseas Crown employee, they can still open up a junior ISA. The type of ISA rule is quite restrictive as well in terms of the junior account, so they can only have one of each type of junior ISA available to them. So what that means is they can't have multiples with different providers. If they did want to change their junior ISA provider, they'd have to do that via a transfer initially, and then they can fund that junior ISA once it's been transferred across. So again, that's quite restrictive rules in terms of the junior ISA. CTF there is child trust fund, so this was kind of the precursor to the junior ISA. So a child can't have a child trust fund and a junior ISA. Again, if they've already got an active CTF, they'd have to transfer that across to the junior ISA before they could actually fund that junior ISA. Moving on to subscriptions, so this is funding an ISA. So in the ISA world, putting new money into an ISA is called a subscription. So just to differentiate it to the pension world, where new money going in is a contribution, with ISAs it's always classed as a subscription. So we have the adult ISA allowance is £20,000 for this tax year, and it's been at that level for a few years now. In the budget towards the end of last year, they did actually announce that that 20,000 level is going to be frozen until 2030. So we're not expecting to see any changes to that, but you never know, always want to keep an eye out on, for. Within the 20,000 overall allowance, there's the lifetime ISA payment limit, which is 4,000. So that sits within the overall 20,000 total limit. So what that means is if you pay 4,000 into your lifetime ISA, you could then only do 16,000 into the rest of your ISAs. A couple of other rules on subscriptions. So the money being funded into the ISA must belong to the investor. So what that means is your employer can't pay into your ISA for you. You have to pay in of your own funds. Subscriptions must always be made in cash, so you can't do an in-specie subscription to an ISA. That's not allowed under the rules. The only exception to that is if you've got a save as you earn scheme or a share incentive plan that's just set up by your employer. When those plans mature, you can actually transfer those amounts into an ISA environment, and that will be classed as a subscription. So it will be limited to the individual's available ISA allowance, but that is one way of putting investments directly into an ISA environment. Managers may accept third-party subscriptions, so this typically will be around like spouses wanting to fund each other's ISAs. So most platforms, and we do it at Invest Centre, will allow a spouse to fund their spouse's ISA. That can be allowed under the rules because it's deemed to be a gift. So once the money's hit the individual, that belongs to them at that point. So it meets that first bullet point there. Junior ISAs again have their own separate limit, so it's 9,000 each tax year. Again, it's been at that level for a few years now. In terms of who can subscribe to a junior ISA, it's actually a lot more flexible, so there's no rules around who actually can make a subscription to a junior ISA. So this is where grandparents, aunts, uncles, anyone really doesn't have to have a connection to the child. They can make subscriptions on behalf of the child. It's deemed to be a gift to the child at that point, so the gifting rules in terms of IHT and things like that will start to apply. It's also an irrevocable gift as well, so we'll come on to this with withdrawals, but once the money's in the junior ISA, it can't actually be accessed until the child turns 18. So if someone does gift funds to a junior ISA, there's no way to undo that and take that money back out. So just one thing to be aware of. As long as the child was a UK resident once the junior ISA was set up, it remains a valid junior ISA until the child turns 18. So even if the child moves overseas, they can still have the junior ISA funded on their behalf. So they don't need to be UK resident, which is different for the adult ISA, because you can only fund your ISA if you are a UK resident at that time. And there's no rules around where the subscriber is based as well. So there's some scope for overseas subscriptions to junior ISAs as well. So just a couple of planning points on subscription. So it's what we call a use it or lose it annual subscription. So there's no option to carry forward unused allowances from previous tax years. So if you don't use your full 20, it will gone and you'll be starting again in the new tax year. Obviously, a couple have a £40,000 annual limit, and then a family, 2 kids, will have a £58,000 total tax-free investment limit per tax year. That 25% boost for the lifetime ISA is quite useful as well, so that an individual technically can have £21,000 put into an ISA environment each tax year, with the maximum bonus from the lifetime ISA. CTFs have been in the news as well recently because a lot of the initial cohort are turning 18 in the next few months and years. So that will mean there's quite a few children who are reaching 18 who've got a maturing child trust fund. So there is options to retain that within a tax-free environment by transferring it either to an ISA or potentially even the lifetime ISA to actually benefit from that bonus if they're looking at property purchase, things like that as well. Just a little bit on the actual management of ISA subscriptions. So currently the ISA manager will report all the current year subscriptions to HMRC at the end of the tax year. So each ISA manager sends a big report to HMRC. They then consolidate all that data, and at that point HMRC will identify any what they call invalid subscriptions. So typically that will just mean someone who's gone over their 20,000 limit with a couple of different providers. So HMRC will identify where the invalid subscription has occurred, and then they'll let the ISA manager know how to perform a repair on that. So if there's an excess of the person's annual subscription allowance, HMRC will say you need to remove X amount of money from the ISA. So that can be done either by a refund to source of those funds, or if the money's been invested, you could potentially just do a transfer out to a non-ISA environment, so into a dealing account or a GIA to actually repair it. That's technically the only way for an ISA to be repaired, so we have to wait for that notification from HMRC. So if an investor finds out they've or accidentally exceeds their subscription allowance, they can't repair it just by withdrawing those funds, because it will still get reported to HMRC. But they can notify HMRC, who might be able to speed up the process rather than waiting for the end of the tax year. So just one thing to bear in mind. Okay, so we move on to withdrawals and transfers. So for adult ISAs, there's typically no restrictions on funds being withdrawn. So there might be some account-specific things like cash ISAs might have a sort of a period where you're locked in to retain a higher interest rate, those kind of things, but they're sort of product-specific restrictions. In terms of the ISA tax rules, there's no kind of limit for when you can take out your ISA funds, so there's no minimum age, and also those funds that are withdrawn don't have any tax liability either as well, so they don't have to be reported, anything like that. So they are free and quite flexible. You just pay money into your ISA and we withdraw it at any point that you do see fit. In most cases, or in some cases, any money that you withdraw out your ISA can't be then funded back in. So that's what's called a non-flexible ISA basis. But we do have the flexible ISA rules as well, which means any withdrawals in the tax year can be replaced later on without affecting the current year subscription allowance. So what this means is you can withdraw money within the tax year and then fund it again, and then the total will be reported to HMRC at the end of the tax year. So it does give some flexibility if people do want to take some funds out and then resubscribe those funds later on in the tax year. Flexible ISA rules are optional for ISA managers, so it depends what the provider wants to do with those. The Invest Centre ISA is flexible now as well, so clients can take out those funds and then put them back in at the end of the year within the same tax year without affecting their overall subscription allowance. So it does give that flexibility. So that's the main types of adult ISAs. The lifetime ISA has a few more restrictions. So with a lifetime ISA, there's two types of withdrawals you can do: the charge-free withdrawals for the prescribed circumstances, and anything other than that, a withdrawal is allowed, but it will have this government withdrawal charge applied to it. So the main charge-free withdrawal we see at the moment is for the first-time property purchase. So that's kind of the main selling point of lifetime ISAs at this stage. So helping individuals to get on the property ladder. So the requirements for that are, so the property itself has to be based in the UK and it must be priced at £450,000 or less. That limit's been in since lifetime ISAs were introduced in 2017, so that's been talked about as being potentially a bit low now as we go forward with house prices increases, those kind of things. So providing it's less than 450,000, you can use your lifetime ISA to help fund it. You must be purchasing the property with a mortgage, so if you're a cash buyer, you can't use your lifetime ISA funds. Funds are paid via a conveyancer, so the solicitor or the legal firm involved will handle the withdrawal of the lifetime ISA funds and then obviously paying it to the mortgage company or the vendor. It must be done within a 90-day window as well. So once the funds have come out of the lifetime ISA, there's 90 days for the property to complete. If it doesn't complete within that window, the conveyancer needs to return those funds back to the lifetime ISA manager. If it's outside of that 90-day window, technically it'll be a chargeable withdrawal, so there might be some penalty consequences for that. In terms of the buyer themselves, so they must be a first-time homeowner. So that means never bought a property before or ever had an interest in a property either. So that can affect someone potentially if they inherited a property. They may have sold it to take the investment out of that property, but technically they would have actually been an owner of a property before, so they won't be eligible to use the lifetime ISA for the first property purchase. Joint purchases are allowed, so if two individuals have got lifetime ISAs, they can both use theirs individually for the one property purchase. And if you're buying a house with someone else, they don't need to be a first-time property owner either. So it just looks at the individual who owns the lifetime ISA themselves. Another key rule that does trip people up from time to time: you can only use your lifetime ISA funds 12 months after your lifetime ISA has actually been funded. So 12 months after the first payment into the lifetime ISA, that's when the lifetime ISA can actually be used for this charge-free withdrawal. So if you're doing it within less than 12 months, you can't actually withdraw the funds without having the penalty applied to it. So outside of the property purchase, the other ones, so obviously from your 60th birthday as well, you can withdraw funds from your lifetime ISA. Obviously, because the lifetime ISAs were only introduced in 2017 and you have to be under 40 to have one, we haven't actually got to the stage where anyone's over 60 yet with a lifetime ISA. So it'll be one for the future to see how popular this becomes in terms of kind of a retirement product as well. Probably the key benefit of this is because it's an ISA environment, there's no income tax to pay on any of those withdrawals. So it does seem to dovetail quite nicely with the pension products as well as kind of a different retirement vehicle. And then obviously the other charge-free withdrawals, things like terminal illness. So someone's got less than 12 months to live, they can withdraw the lifetime ISA funds without a penalty. And then obviously on death of the investor as well, the funds can be withdrawn without having any penalty applied to it. So outside of those and the property purchase, any other withdrawal from a lifetime ISA is classed as a chargeable withdrawal, which means the government withdrawal charge is applied to it. So currently this is 25% of the value of the funds withdrawn, which on the face of it looks like it's just clawing back the government bonus, which is 25% when it goes in. But because it's of the higher gross amount now, it actually works as a slight penalty as well. So it's kind of just over 6% is actually deducted if you invested the cash, or if you put in the cash and then withdrew it straight away. After claiming the bonus, you'd actually have less than you ended up with initially, which is not ideal. So the lifetime ISA might not be suitable for all individuals, particularly if they're not going to use it for a house purchase or for later life. The ISA managers have to deduct the withdrawal charge before they pay out the funds as well. So the investor will only get the net amount after that penalty charge has been deducted. So again, this is seen as slightly controversial because people are ending up with less money than they paid in, and we'll come into that with some of the lifetime ISA reforms that might be coming down the track. Looking at the junior account, so this is pretty straightforward. As I said before, you can't do a withdrawal from a junior ISA. So while it's in a junior ISA state, so before age 18, there's no option to make a withdrawal. The terminal illness and the death rules do apply, which makes sense and it is consistent. But outside of that, you can't withdraw funds from a junior ISA at all. So as I was saying, if someone does make a gift to the child in their junior ISA, there's no way to reverse that. It's locked away till the child turns 18. At which point the account converts to an adult account, and then obviously the adult ISA rules will apply. So the child will become the legal beneficial owner of it at that point. So they'll have full control. So they'll actually be able to withdraw it all out on their 18th birthday if they wanted to, or hopefully they'd keep it invested in and keep funding as well. In terms of transfers, so again, relatively straightforward. There used to be rules and restrictions around types of ISAs that you could transfer to. So you could used to be only able to transfer to the same type of ISA, but that's changed over the years. So it's now fully free to transfer between the different types of ISAs. So you can move from cash into stocks and shares and vice versa. So that's pretty flexible. The only restriction around the lifetime ISA is funds that are transferred from a non-lifetime ISA to a lifetime ISA are restricted to the available lifetime ISA payment limits of the 4,000. So that will be the cap if you're moving from a cash ISA to a lifetime ISA, but funds moving from a cash ISA to a lifetime ISA will still be eligible for the government bonus as well. So that is potentially useful because you'll get that up to £1,000 government bonus paid into the lifetime ISA as well. Junior ISAs, again, it is flexible in terms of transferring between cash junior ISAs and cash stocks and shares ISA. Just bear in mind there is that rule that a child can only hold one of each type at any one time. So as I said previously, if they did want to change ISA provider, they would have to initiate the transfer first, move the funds across, and then fund the new either cash or stocks and shares junior ISA. They can't have two running concurrently because that will break that eligibility rule. The child trust funds as well can be transferred into the junior ISA. Again, a child can't have both the CTF and a junior ISA, so if they do already hold the CTF, they'll need to transfer that across before they can start funding a junior ISA. It has to be done within a 60-day window, but I think HMRC are fairly lenient on that in terms of they won't invalidate junior ISAs if there's a small delay with that. Another key point is the registered contacts need to be the same at both parties, so within the seeding provider and the receiving provider. If they're not, the transfer can't go through, so they'll have to change who the registered contact is at either party involved. A couple of final points on transfers. So kind of a key that sounds pretty obvious is that the transfers almost must be arranged by the ISA managers. So you have to go through the formal ISA manager transfer process. So with that, the ISA manager will give what's called a transfer history form as well to the receiving scheme. So that confirms all the subscriptions that have been made that tax year and in previous tax years as well. So the receiving ISA manager can put that data in for the reporting purposes. Sometimes we see situations where someone's tried to initiate a self-transfer, so moving funds from one ISA manager to the new one, but just doing it via kind of withdrawing funds from the ISA and then subscribing them into the new ISA manager. So they've cut out the kind of transfer process there. That's probably not an issue if it's a small amount of funds. So if you've got a few £100 in a cash ISA that you wanted to move in a stocks and shares ISA and you didn't want to go through the transfer process, there might not be too much of an issue just doing that. But if you had, say, £60,000 in a cash ISA and you wanted to put that in a stocks and shares, obviously if you withdrew that money, you're then going to be restricted to £20,000 a year before you can actually put it back into the stocks and shares ISA. So just a key point that the ISA managers have to arrange the transfer process accordingly. On transfers out, the rules say that ISA managers must allow full transfers out. So if requested, they can't just kind of keep hold of that money. However, doing partial transfers is optional for ISA managers. So some ISA managers may allow partial transfers, some may not. So it's worth checking with the provider if you only wanted to move a small proportion of a client's funds across. A quick note on ISAs and death. ISAs remain a tax wrapper or keep their tax wrapper status up to 3 years after the individual's died or when the administration of the estate is completed. So whichever's sooner, that becomes the point where the ISA is no longer, it loses its tax wrapper status. So while it is still in the tax wrapper status, there'll be no income tax due on any dividends or anything that's generated. And again, any of the gains that are happening are still free of capital gains tax in that period. ISAs are included in an individual's estate for IHT purposes, so they'll be paid out at the direction of will. So the ISA manager will liaise with the personal representatives or the executors of the estate, and then they'll be able to decide what to do with those ISA funds. So whether liquidate the assets to distribute with the rest of the estate, or there might be the option to transfer it in specie, the investments across to the spouse or whoever may also be potentially named in the will as a beneficiary. Also, ISAs on death have what's called the additional permitted subscription. So this allows the spouse or the civil partner to inherit an extra ISA allowance based on the value of their deceased partner or their deceased spouse's ISA at their point of their date of death or when the ISA is closed. So this gives an individual an extra ISA allowance based on the value of the spouse's ISA at that point. So the APS value is either at the date of death or the date that the ISA is closed, and it's actually whichever is greater. So within ISA, if the ISAs continue to grow following the date of death of the member while the estate's been completed, you can use that value as the APS value. Once the APS has been confirmed, it must be used 180 days after the administration is complete or 3 years after the date of death as well, so whichever's later of those two values. So it's kind of a 3 year from death or 180 days after the administration. So if it's quite a complex estate that might take a number of years, that might be the value you can use for the APS. So just a quick example, just to put that into some context. So we've got a married couple here. The husband passes away, leaving his whole estate to his wife. The ISA at that point was worth £75,000 at death. The administration of the estate's completed a few months later. The ISA is now worth £78,000. So that's the value we can use for our APS value. So what that means is the surviving spouse here, she can pay £20,000 of her own ISA allowance, and she can also use £78,000 of her deceased spouse's APS allowance as well. So she can do a total of kind of £98,000 there. She doesn't have to use the specific funds that were in her husband's ISA, so she could use her own free cash if she wanted to, or she can ask the ISA manager to transfer the investments directly into her ISA using the APS there. So ISA managers will can operate differently with APSs, whether they'll allow them from external ISA managers or just within the same kind of platform. So it's worth checking with the provider how they actually manage that. But yeah, ISAs do have a little slight potential death benefits outside of just the kind of tax wrapper nature. Cool. So just to cover off some of the kind of the talk that we've had around ISAs, as I said, you've probably seen there's quite a few bits in the press recently around potential changes to ISAs. So there's a couple of things that have been announced that are actually changing, and then also some speculation around some future changes that we might see. So the Chancellor a few weeks ago now had delivered her Mansion House speech, so looking at all kind of financial services regulations and potential changes to kind of the financial services world. Ahead of that speech, there was a lot of quite strong rumours that it looked like they were going to announce that the cash ISA subscription limit was going to be cut, or even some talk around maybe cash ISAs being abolished. Following those reports, which were reported as kind of this is going to happen, so there was obviously some leaks or quite a lot of strong speculation that this was going to happen. There was quite a big public backlash, people like Martin Lewis seeing it as quite a negative development to actually reduce the cash limit, the ISA cash allowance by some means. So it does look like that got U-turned, because ahead of the speech there was reports that they weren't going to do it, and then indeed when the Chancellor did deliver her speech, there was no announcement around the cash ISA. So this speculation around cash ISA, it's kind of comes from few different angles. Obviously the government have this growth agenda where they want to get more people investing, get more money into what they call UK PLC, and it is viewed, and as we saw in the statistics that I put a couple of slides ago, there is a lot of money that is just being sat in cash in the ISA environment. So they do need to look at a way of hopefully encouraging more people to invest that money rather than just leaving it in cash for the long term, because that's seen as having poor customer outcomes. So there's going to be a lot of different ways they're looking at doing this. You've probably seen the FCA looking at this targeted support as well, so hopefully nudging more people to look at actually investing money or going to get advice where the advice will be looking at investing it as well. So it does look like we are going to see some changes within that, but it's just kind of one to keep an eye out for at the minute. Another fairly big piece that came out a few weeks ago was the Treasury Committee's review of the lifetime ISAs. So the Treasury Committee is not part of government, but they scrutinise and look at government activity to make sure that it's working well. So they looked specifically at the lifetime ISA, seeing if it's good value for the government, because obviously they fund that bonus, which does have a cost to the Treasury, and just generally how the product's working. Is it working as intended? The report, it wasn't overly negative of the lifetime ISA, but it did identify particular issues, as we've already mentioned, around that penalty charge, how that's applied. There are a number of people who are having to have that penalty, and it is disadvantageous to them because of that. Things like the property price I already mentioned, that does seem quite low for particular areas of the country where 450 doesn't buy you very much, so whether that needs to be some reform on that. So the government at some point will respond to the Treasury Committee's report, so we might see some development with lifetime ISAs, or whether they blend this into what we're thinking is going to be a further review of how ISAs are working in generally. So we could see some changes to the lifetime ISA environment. Going back to the Chancellor's speech then, so as I said, there was all this talk that there was going to be some big changes to cash ISAs, but that didn't materialise in the speech itself. The only mention of ISAs themselves was this line here that I've just cut out. So the Chancellor recognises the potential for reform to improve returns for savers. So that does sound like moving away from sort of low interest cash ISAs into some more investment based ISAs, and then again that access to capital for UK businesses, so some sort of way of investing in UK businesses and UK listed companies. So they'll continue to consider further changes to ISAs engaging widely in the coming months. So that does sound like there will be some consultation potentially on how ISAs are working. So what changes they'll look like, it's quite difficult to say. You may remember the last government had this idea of a British ISA where you could only invest in sort of UK-based companies, which did get shelved when the new government came in. I think there was a lot of speculation and criticism of that idea because how it would actually work in practice isn't always as straightforward as it seems. And similarly, restricting how much people put into cash ISAs is actually quite difficult to do, because if they do drop the cash ISA limit, they'd have to build some sort of mechanisms to stop people just holding cash in a stocks and shares ISA. So again, it's not always as simple as it actually seems. So one to keep an eye out for ahead of the budget in the autumn as well. There might be some significant kind of reforms or ideas around ISA changes. A couple of things that have been confirmed. So in the Mansion House speech, they did actually announce that long-term asset funds, so LTAFs, will become a permitted investment for stocks and shares ISA. So this is coming in from April next year, so when the new tax year starts. So you may have seen these long-term asset funds are particular funds that invest in more kind of illiquid kind of infrastructure type investments. So there's not as much liquidity in them. So they will be a permitted investment from April. I think it will be dependent on ISA managers whether they want to allow LTAFs on their platform or within their permitted investment range. So probably want to check with the provider if it is something that might be particularly interest of clients. And then looking ahead, there's a wider project around the digitisation of ISAs. So from April 2027, they'll start a new reporting regime for ISAs that's going to be done in more of a real-time fashion. So at the minute, as I was saying, it's kind of done at the end of the tax year. These big kind of data sets are sent to HMRC. So they're hoping to look at doing that in this kind of real-time fashion using kind of the API processes that exist in other areas of HMRC reporting. So part of that change, national insurance numbers will be a requirement for ISAs because they're not actually currently at this point. But there will be a carve out if you're not eligible for a national insurance. You won't have to provide it if you can't. So we'll see that, and there'll be more developments, I think, in that digitisation period as that project moves on. Okay, so that's pretty much everything I had. So yeah, just to summarise then, so ISAs are still very popular. You see that kind of over 70 billion paid in each tax year. So they still remain popular with investors, and they are a very nice tax advantage. The 20,000 allowance is fairly generous when you look at other allowances that are available and cuts in other and CGT rates, those kind of things as well. So yeah, still remain a really useful tool in terms of tax planning. And it does look like there will be some reforms to ISAs coming down the road, or definitely looking at potential reforms. So one to keep an eye out for. So that's everything I had. Happy to have any questions or anything put into the report here we have. We'll be able to pick those up and come back to you after the session. But thank you very much for your time, and we'll see you in the next session.